It's Monday, the 26th of February, and I'm looking at the US stock markets, the E-mini S&P, the Nasdaq, and the Dow Jones futures contracts. This is the E-mini S&P. This is the weekly chart. So I've got my Fibonacci levels. You know I love my Fibonacci levels. I've got them going all the way back to 2009 low. So that was the global financial crisis low. And of course, we've had an enormous ramp up since then. Why have I gone back that far? I just want to make sure that I get the correct levels in the shorter term. And I like to look at the longer term charts to do that. So I'm looking for a swing low around the 38.2% fib, just to make sure everything lines up correctly in the longer term. And this does. So I'm quite happy that we have that fib level from September of 2022. So it's really since September of 2022 that we've had this big run up. So that's nearly 18 months. Of course, we spent a lot of time going sideways before we really got the momentum going, which was October of 2020. You can see that we've had a really good run up from 4,120 up to about 5,120. So that's a steady 25% gain in just 4 months. If you're long stocks, you're doing really well. What happens next? I'm going to go to the daily chart now, and I'm purely focused on that last 4 months worth of data, that really strong bull run that we are in now. There's one thing that concerns me. Although we're in a very strong bull trend, the way the Fibonacci levels do line up, and I'm just going to remind you, I've taken a swing low from that weekly chart at the 61.8% fib. Let me just show you what I mean. Taking the October low, I put my Fibonacci levels on there. I see a perfect swing low around the 61.8% fib, which means all the Fibonacci levels are lining up perfectly. The next fib level I've taken is from the swing low at around the 38.2% and the 23.6%. The 38.2% is the swing low from October 23. The previous swing low I've got there is from October 22. Now, this is slightly concerning to me from a bullish perspective because all the Fibonacci levels are lining up so nicely. It makes me wonder if at this stage the bull run's had its day and we're going to have either a sideways consolidation or maybe a correction to the downside. I don't have a sell signal. I don't have any candle. I don't have any pattern. It's just an early warning to me that the Fibonacci levels have all lined up so completely that maybe this is the end of the move. I don't know if you understand that. If you're not sure what I mean, put your questions in the comments box. Now I have to wait for some sort of confirmation from candles or from patterns. We have a very minor, I wouldn't even call it a negative candle. I'd call it a neutral candle. On Friday, we pushed higher to a new all-time high at 51.23. We pulled back. We closed only a fraction up, but we still closed up on the day. We still have a small green candle from Friday. So it's not a negative. It's just we don't want to see a long upper wick on a candle in a bull trend. We want to see a big green body, of course. So there's no sell signal. There's no indication that the market's going to collapse. If we were to dip on the daily chart, we do have good support around 100 points lower. So that would be a 2% drop. 2% is really nothing, is it? A 2% correction would be healthy in the context of such a strong bull trend. But I'm not saying it is going to happen. I'm saying it's a possibility. And if we get down there, that should be a good buying opportunity. This is the 1 hour chart. So I'm really zooming in now. And even if we did have a dip in the E-mini S&P, we may not even get down to 50.25, 50.20. We've got this trend line support around 50.50, and we do know that the bulls are always standing on the sidelines with spare cash ready to buy the dip. So can I put any fib levels on there that would back up that trend line that I've got there? Yeah, I could take this swing low here for sure. That is around the end of January. Where does that take us to? 50.60, which is the previous all-time high in the middle of February. So I quite like that as a level too. 50.60, what's this trend line? 50.50. So that 10-point band would be a good initial support level in the S&P, in the E-mini S&P futures. Remember, this is the March futures contract I'm looking at, not the cash futures. 50.50. If we do get down, as I said, to around the 50.25 level, that would be a much stronger support level. And even from the moving averages that you see on the hourly chart right now, the 200 moving average, the red line, is around that 50.25 area. By the time, if we get down to the 50.60, 50.50 area, the 100-hour moving average, which is just starting to turn back up again after that consolidation phase in the middle of February, that blue 100-hour moving average would also be giving us support around the 50.50, 50.60 area. So those are the two levels for me to start attempting longs if we get a very small correction this week of 1% or 2%. I'm a trend follower, so my strategy would always be to buy into a support level in a bull trend unless we have a very clear signal or pattern that's telling me the market has topped out. And a good example of a pattern which might worry me for stock markets would be a double top. And we do have possibly a double top in the Nasdaq. You can see that in the middle of February, we reached a peak of 18,121. On Friday, tried to get through that. We got to 18,144. But what's worrying me is, and you can probably see this better on the daily chart, the market pushed up, new all-time high, and then we closed lower. Can you see that from this candle? Not really what you want to see in a strong bull trend, especially when you reach a new all-time high. You want to see a green candle. You want to see a close above the previous all-time high. We haven't got that on the Nasdaq. We made a new all-time high. We closed below the all-time high. We closed below the previous day's high. So on Thursday, we reached a high of 18,087. It did look like we were going to break the previous all-time high, make a new all-time high, but this is not what you want to see. I want to see a big green candle. I want to see the market closing towards the upper end of that candle. I want to see the market closing at least above the previous day's high and certainly above the all-time high to confirm that we have a breakout. So this is more worrying. Long upper wick, small red body on the candle and a close below the all-time high and the previous day's high. Do we have a double top here? It's too early to tell, but there is definitely the risk of a double top. Now, a double top is not confirmed until you've broken what's called the neckline, and that would be down at 17,372. So we would still need to drop another 250 points before we've got confirmation. But there are a lot of people that think we're in a bubble. There are a lot of people that think that the market's overdone on the top side. If you're one of those people and you're looking for a reason to sell the stock market as a bit of a gamble, well, you've got a good enough reason, really. If you were to sell around here, around the 19,960 area, you'd need maybe a 70, 80 point stop to stop out just above the previous all-time high, relatively small. Even if we only dip to the first reasonable support level around 17,550, that would still be a 400 point drop. That is a good risk-reward ratio, risking 80, 90 points to make 400 points. We're all going to do that. That's more than 4-to-1 risk reward. And all you'd be looking for is a dip to the first Fibonacci support level. You're not even looking for a major correction. You're only looking for really a sideways consolidation in order to take a significant amount of profit out of that trade. So there's my suggestion. If you're itching to get short, this would be your opportunity. We have a situation where the three stock markets are not really giving me the same information. So the Nasdaq looks a little bit negative. The S&P may have topped out and may be entering sideways consolidation, certainly no sell signal, as I've said. But the Dow Jones actually looks really strong. We had a longer period of consolidation here than we did in the other markets, and then we burst up on Thursday, and we continued higher on Friday, and this does look more positive. Let me expand this so you can see more clearly. We've got more of what we should see in a bull trend. The market broke up, beat the previous day's high. On Thursday, we beat the previous all-time high. On Friday, we closed up. We made a new all-time high. We've got a decent green body on the candle. It would be nice if it was bigger and we closed at the upper end of the range. But the fact that we closed above the previous all-time high, we closed higher on the day. We didn't close above the previous day's high, so that would have been nicer. But you see what I'm saying? This is more of what you want to see in a bull trend. And there isn't really any indication here for me that the Dow Jones is about to have a correction. Maybe you want to put a spread on. Maybe you want to buy the Dow Jones and sell the Nasdaq and see if that works. See if the Nasdaq does have a correction. Let's see if the Dow Jones does hold up. As long as the Dow Jones holds above this little horizontal line here, which is around 38,900, then the bulls are safe. Below there, okay, yeah, we could dip down to 38,500. Not that much. It's only a 500 point drop. Worst case scenario, we're looking at around this 37,800, 37,700 area. But I do think the downside will be limited. But if you are keen to get in on the bull trend, then 39,000, 38,900 is the first support level in the Dow Jones for this week. Okay, I hope that's helpful. There are links for you to get some free stuff. Join my Telegram group, sign up for my 5-day challenge in the description box below. Don't miss those.